Before we started recording this one, we actually had to change the name of the show just because we had some OPEC Plus headlines. And I think it's important, and it ties in well with the Russian seaborne crude chart that we're seeing here, because there was comments out of Saudi that they saw a disconnect between the physical markets and the paper markets. And that was one of the things that they were talking about, cutting supply to help alleviate some of those differences. So in true to form fashion, the OPEC Plus, the OPEC Plus has two different pieces to it. There's obviously the ministers that make the decisions and then the analysts that support them. So there's normally a commentary between the two, and they'll publish some of the things that they say. So here the OPEC Plus coalition tightens its outlook for global oil markets this year and next as members struggle to reach output targets. The Alliance's Committee of Technical Experts slashed forecast for this year's supply surplus in half to 400,000 barrels a day, according to the report. It flipped projections for next year from an overhang of 900,000 barrels a day to a deficit of 300,000 barrels a day. The revisions reflect that many members can't meet their output targets. The Joint Technical Committee, which analyzes markets on behalf of ministers who meet on Monday, also endorsed a recent declaration from group leader Saudi Arabia that they're prepared to resolve a growing disconnect in global oil markets by curtailing supply. So it's interesting now because you have the surplus being diminished. You have next year's surplus being diminished, but they were talking about curtailing supply. So now is this putting them in a position where they can come out and say, we're just keeping everything the same? Because the cuts that we were going to do are already in the market. They're already creating a shortfall, so there's no need for additional cuts. Because Saudi Arabia had said, we were thinking about cutting crude flows further. So you could say, well, okay, but we would, but we don't have to. And this is why, because we're not going to have the surplus we expected. Next year's already in a deficit because of West Africa, because of Libya, because of Iran. And again, Libya and Iran are outside of the agreement, but they can talk about those shortages that are being created in the market, because this is looking at global surplus, global adjustments. And that's where you still have to factor in, and Libya being back, and I think what happens with Iran is going to be important, which we'll talk about in a minute. The other shift is what is happening with Russia. So when you look at Russia's seaborne crude, 4-week average crude shipments from Russia by destination, you can see that the crude shipments to Asia have fallen by more than 500,000 barrels a day in the past 3 months, hitting their lowest level since March. But again, they're still fairly stable. And that's what we keep talking about. Total flows fell to 3.04 million in the 7 days to August 26th. Which compares to 3.62 million the previous week. There's always going to be that disconnect, because where are the ships? How quickly can they get there? Are there buyers for it? Because if you're not selling to Asia, where are you selling the crude? Because you don't have the same type of buying. Libya coming back helps alleviate some of the issues within Europe, even as CPC continues to flow at a reduced rate. But that's, again, so Iran is kind of that swing piece into what can go into Europe. But with that being said, I think it's going to be a very interesting dialogue with OPEC Plus, because you have Russian exports that are up, but production in general is down because they're not moving as much by pipe. So you have Russia that's come off. You have West Africa that remains very sluggish and very low, even with a elevated amount of floating storage. You have the Middle East, which has a lot of floating storage that started to come down. They've been cutting differentials to get that down. And to be clear, Saudi Arabia does not cut OSPs. They will give you incentives that discount it down, but they'll never sell like, okay, if the OSP is 12, we'll give it to you for 8. They'll give you things like, free storage for 2 weeks on board if once it gets there. They can give you a discount on the freight rate. They can give you a discount on, there are things that they can do to back out or back or bring that OSP lower just through some of those incentives, because we've seen Murbain trading at a discount, which we'll talk about. We've seen Somo out of Iraq, talking about how they can increase production. We talked about that in segment 1 on the geopolitical side. And with the Cedrists, and that's again because of Sadir, who is the person that they are supporting, and that's again some of the backdrop, and we'll discuss it more in the Econ show. But these are the pivots that we have to look at, because now you have Iran. How much of that is sitting in the water? Will they try to discount it ahead of that, like they did in 2014 into 2015 when they knew the Iranian deal was coming? They wanted to take away some of that monetary value of what was in storage by discounting it, because you're going from, in Iran's perspective, you're going from selling all of that crude at a steep discount because you're trying to incentivize people to get it, to selling it at market rate. So they will try to knock down some of that value by, again, trying to alleviate some of those issues, trying to push that lower. So again, these are some of the key pieces that we have to look at, which is why this is actually going to be a fairly important meeting. And the other side of the equation is, and this is where, when you, again, just to use their numbers, when you look at the underlying expectation, the Committee of Technical Exports slashed forecast for this year's supply surplus in half to 400,000 barrels a day. But when you consider China, for an example, so China is importing about 3 million barrels a day less than normal. So if we're at 100 million barrels a day, 3%. So, and again, it's not the same because 100 million also includes liquids, but just keeping it simple, 3%. So then you have the U.S., which has been importing about 1 million barrels a day less. So that's another percent. So when you start looking at 400 plus, 300 minus, what does a recession look like? Do you see things coming much lower, especially given where diesel prices are and heating oil prices? That's going to crimp demand further. And again, even though supply is lower, you're pushing demand towards it, which will then push supply back up, which I think they're going to have to address, because if you look at the last, what feels like the last 6 or 7 meetings, they've been under 10 minutes. And that's not usually how this goes. And I think this is going to be one where they're going to have a lot of things to discuss and talk about. And a huge piece. So this is Kepler's view, with over 90 million barrels of crude and condensate stored in tankers offshore, speaking about Iran. So Iranian nuclear deal has thrown the spotlight on the sizable cache of crude held by Tehran that could be swiftly dispatched to buyers in the event of an agreement. About 93 million barrels of Iranian oil is stored on vessels in the Persian Gulf off Singapore and near China, according to Kepler, while Vortexa estimates it to be 60 to 70 million barrels. There are also smaller volumes in onshore tanks. So regardless of, is it 70, is it 90, there's crude sitting there. There's condensate sitting there. And Europe would like to get access to it. The U.S. is agnostic, I think, at this point in time, as to where does it go. And I think that is where you're going to see the deal get struck between Europe as well and Iran, and that will unlock. But what does Saudi want to do about the value of this product? Because 90 million barrels a day at, let's call it Brent, which is currently at 96.5. So that's a decent chunk of change that's going to quickly come back into the market. So do they try to do something to discount those barrels ahead of this in order to keep this windfall from all of it reaching the Iranian government? So now on the U.S. side, right before we get into the U.S. data, so when we look at U.S. flows, so Europe surged. Europe is scooping up American crude, and it's again because of the oil ban. You have Libya flows that have come back up. You have CPC that's come down. You have Iranian crude sitting on the sidelines. And, well, let's get U.S. because when you look at U.S., so WTI currently trading at $90.73, about $6 cheaper than Brent. And, again, when you think about Dubai, so Dubai is currently $5.30 below cheaper than Brent. So when you have to compare kind of where things are right now, LLS obviously being the better view of 93.49. So it's only about $3 cheaper. But when you think about shipping and where you're coming from, the $2 disconnect where Oman Dubai is $2 cheaper than LLS or US flow. And then I could also pull up the Houston Ship Channel, which is also an important one when you're looking at exports. Those are the two that are going to give you the indication as to where are flows going, and all things are pointing to exports out of the U.S. being supported. While I've been talking, I was pulling up the Mars, and when you look at just some of the different backdrops, again, it's just going to be supportive of where things are. LLS is trading at a fairly normal level as we continue to see some of these flows and some of the underlying crudes, and that's going to keep Europe again buying U.S. crude product, which is why the 4-week rolling average is sitting at 3.8 million barrels a day, which is still above what we were assuming. But again, when you look at it, it's still coming in very healthy. And here's Magellan. I was just waiting for it to load. So MEH, which is Magellan East Houston, 93.39, LLS 93.49. So again, you're seeing that is the price that is being charged or being purchased, where our crude is being purchased at. Which, yes, it's still a bit more expensive than Oman Dubai, but factor in shipping and it becomes a bit easier. So that's where we continue to see those demands flows. Now, Middle East crude, as you can see here, has been dropping. It's still above where it was really outside of 2016. So you're still at a very high level, but that steep drop off is, again, trying to push this into the market, trying to get this crude through. Now, a Thai refiner bought Abu Dhabi's Murbain crude for October loading at a premium of $5.30 to $5.40 a barrel to the Dubai benchmark. Spot cargoes of Murbain crude had traded at about a $6 premium to Dubai before becoming off in recent transactions. So this is what we've been talking about, where you were at 6, you had these, and now you're starting to see this come down. And it's to try to incentivize those moves, trying to, again, take this floating storage and push it into the market ahead of your September loading schedule, because again, you want to make sure that you have enough space, you have the buyers. But if you push up pricing, and as we've already seen for September, then that's going to lead to what does October look like and what are those prices going to be. And here's when we look at, again, that discount of Dubai versus Brent sitting at about $5.35. That's why we continue to see these pressures on the differential front. And when you look at the curve, and we'll show this in a minute on Brent, you've seen that time spread really fall off. And that's usually been a decent indicator of some of the pressure that we're seeing on the curve. Just in terms of near-term demand, we've seen some of those discounts on the differential side. So when you hear Saudi say that there's a breakdown between physical and paper, maybe they had it backwards, and because physical is getting a bit weaker while the paper has started to come back down. But as we've been saying, just given the views in the market on inflation, the dollar, economic macro drivers, there's still that staying power here. Like, we're not saying that you're going to get this huge drop off in pricing at this point. But could WTI go to 85? Sure. Could it go to 95? Sure. Like, there's nothing to indicate the next $5, because if Iran comes to market, you're going to get a huge washout in price, and I'd be buying that. If OPEC comes out and says that they're going to cut supply and that prices are going to go up, you're going to get a big spike, I would short that. It's just going to be a matter of kind of playing the market in terms of positioning, in terms of where people are, because you're just seeing a lot of these different flows. But holistically speaking, the physical market based on differentials are getting weaker, while the financial market's coming down, but not to the same degree that we're seeing some of the pressure on the physical side. And here's another reason why. Global crude oil on the water has reached a new record. So we are now clear above, we've taken out the highs for 2022. We're above where we were in 2020 because we have a significant amount of crude on the water. And this is a mixture of, again, transit, which when you look at transit is a huge driver of it. When you look at where this is the highest it has ever been in for this time of year, obviously 2020 you have that big spike in April. But this is the highest it's been in 2022. This is the highest it's ever been at this time of year because there is a lot of crude in motion. It's what is coming from Russia. So it's not surprising to see their exports come down because they need ships. Where are the ships? Oh, they're already moving crude. Well, you have to wait for it to get there, and then can it offload? And we're still seeing a lot of crude in storage, which means that it can't offload right away. So they have to wait for that cargo to come back, which we're seeing here. And as we've been saying on the floating storage side, we're just going to match 2021. I don't think we're going to be much above, much below. It's going to be very similar to 2021 levels because we don't have a lot of refinery run rates. We have run cuts out of China. We have, I don't want to say run cuts out of the U.S. because it's just we're fairly normal. We're getting some economic run cuts, obviously, out of Europe, and we're getting a little bit of slowdown coming out of Asia. And these are the things that are going to leave this product in the market and keep some of those things a bit slower. All the while, Asian floating storage has come down a bit, but we've seen China start picking up some additional cargoes. And again, coming back to the Middle East with some of those discounts rolling through, there's incentivizing some additional purchases. This is why, again, we just think that this is going to be very close to 2021 levels when you look at Asia, because they are picking up some additional cargoes, but they're doing that while they're also cutting underlying run rates. So when we look at it in general, here we're seeing that we're getting a drop of the amount of capacity back. And so the estimates is that we're going to get to about 57. So here we're getting to about 57% utilization rate. But gasoline shipments rose. They're getting cut again in September. So they're trying to protect different things. So when you start looking at some of the underlying volumes, here you can see that run rates are sitting at about 61%. So there's about another 4% drop that's expected coming out of Shandong. And that doesn't include the fact that state-owned and the large entities never really ramped up. But they're still, again, buying that crude. They're managing and they're trying to be buyers of opportunity. But the issue that we've continued to highlight is that China was the clearing agent. So when you had a conversation with a commodity guy, you would say, oh, well, where is the excess going to go? And they're like, oh, China's going to absorb it. So China's always been the balancing factor. And our whole point is they're becoming less and less of the balancing factor because of their economic shortfalls, because of the struggles that they're having. They keep trying to invest in infrastructure, but they've been doing that since 2008. There's only so much infrastructure you can build before you're building on top of buildings. And it's not even a joke at this point. They're blowing up half-finished buildings to start building on that same location again. Like, the whole thing is absurd. But even with that, they're not getting back to normal. They're not seeing that. So again, as more crude shows up, they're going to have to increase run rates. And if they increase run rates, they're going to have to export. So they're going to continue to be the swing where, yes, they may increase imports of crude, but they're also going to increase exports of product. And it's important to look at both sides of that equation. While West Africa has their floating storage has moved down, but seasonally adjusted, still all-time high as they continue to struggle to push that crude into the market. But here are China's super tankers. That big pivot up increased again, and it's not surprising to see cargoes moving out of the Middle East, to see some fairly stable moves out of Russia. All of this is going, and again, a lot of this is being targeted towards China, which is going to increase the amount of floating storage, which again is going to increase and maintain the crude on the water, because we continue to see floating storage come down in the Middle East, but again, going up in transit. So now when we look at the U.S. Motor gasoline, you had another increase of 120,000 barrels a day of exports, 329,000 above the 5-year. Here you can see there was a drop of 35,000 barrels a day for distillate, but still very strong, while propane had a drop of 450,000, still, again, well above this 5-year average, sitting at about 1.2. With crude oil exports coming in at about 3.96, just down 210,000 barrels. We think that there's a little bit more downside on the crude, but not like it's going to 2.7. I mean, it could, just in terms of documentation, but in terms of actual flows, it's going to remain at that 3.7, 3.8 million barrel a day flow. Finished gasoline, we were expecting it to come in and stay right at the top of the cloud. Instead, it shifted a little bit further up. Again, going to remain strong, going to remain at the top end of that cloud, or making no seasonally adjusted highs. Distillate came down a bit, which is what we were saying in the top end of the cloud. We do expect it to continue to fall. It'll still be above the 5-year, but again, continue to come down just given where storage is in the U.S., but can they get it to where it needs to be, which is pad 1, because storage is fairly flat in pad 3, so they have to manage that. So are they sending it into the East Coast? Are they sending it into the international market? And again, that's why we're going to still see this a bit elevated versus what we should, if you think about where storage is in the U.S. U.S. ethane exports came down a bit, but still remain strong. We still see that staying fairly elevated. And this is looking at, again, exports for U.S. crude, staying strong, staying at that top end, which we think is going to remain, with propane, propylene, again, coming down, but still, as you can see here, staying at the highs. Now, when we turn to the Fujairah, products had an increase. They're back to 21.972 million. So with a build of 184,000 barrels. So they're still fairly strong. Stock movements saw a large draw across light distillate. So we want to look at where light distillate is, where heavy is. So light distillate fell by 1.149 million to 7.273 as they fell to their lowest level since the end of July. The East of Suez gasoline complex was under pressure as it tracked a narrowing U.S. RBOB Brent crack as gasoline demand is expected to fall globally approaching the winter months. So it's interesting because the expectations of traders is that it continues to weaken. My expectation is that it continues to weaken, but you still had this dumping into the market. And it's when you look at that move, a lot of that, I believe, is just taking advantage of the market at this point, because some of this product was, again, priced at a discount because they want to make room for middle distillate. But in order to make room to make more middle distillate, you have to make room in the gasoline storage. So you're going to push that gasoline into the market. Most of this did go into East of Suez. But the question is where East of Suez, and a lot of this went into Central Asia, where they continue to put on tenders and then pull them. So now we've actually seen some of these tenders stick. So this is some of that backlog where there was always demand out there. It's just it couldn't get filled because the price was wrong. Prices came down for gasoline, get filled, and now we believe that you're going to see some sizable build in gasoline over the next few weeks, because this is one of that last push, and now you can start to refill as the Middle East, when middle distillates rose 216,000 barrels, which again is still just over 3 million. So the East of Suez gas oil complex continued to bolster by that open arbitrage between West of Suez and East of Suez. So remember, this was part of that floating armada of diesel that went from the Middle East into Europe and is already there. There's still some backlog to come through, because you'll see fuel oil going from Europe into Asia, and you'll see diesel and middle distillate coming from Europe, coming from the Middle East and Asia into Europe. Heavy resid on the other side, as we said last week, was going to have a big build. It had a build of 1.18 million, again, back over 11.5. So bouncing back above the 11 million barrel mark. Trading activity for bunker in the port was steady, with activity expected to gain momentum in September as low prices attracted buyers. And again, it's just a matter of heavy resid heavy fuel oil, that is where you're going to see some of the demand as they try to pivot away from some of the middle disti. And here's that big drop in the Brent spread. When you look at the difference between October and November, there's a mixture in terms of where things are. There's the roll that's coming up. When you look at as we come into September, guys are preparing for that. But realistically, it's just you're seeing some of that cooling off at the back end of the curve, which we're seeing in WTI, which is why when you hear commentary from Saudi, then you look at the curve. Then you look at time differentials, then time differentials. Then you look at underlying differentials of spot. You're like, well, that it doesn't appear all that bullish on the physical front. Now, when we look at the shifts in exports, Libya is back to 1.149. So when you look at it, they're actually getting back above where they even finished. And again, they're looking to get to about 1.2 million barrels a day of exports, trying to get production to about 1.35. The question is, can they? I'm going to say no. I'm going to say even that is high. I think they can very comfortably sit at about 1.08. But sitting above 1.1 is going to be difficult over the longer term. They had storage building up, they had flows, they had shuttered shuttered ports even as storage was filling up. So again, I think this is more of a September thing, not a continuation, and it'll stay. But again, stay above 1 million, barring obviously more political upheaval, which is never off the table when you were talking about Libya. But now when you look at Angola, again, still very low. They're still not. But if you think about why are they low in October, I think here's an important one. So for Senegal, spot offers, so 950,000 barrels of Girasol loading offered at $575, more than dated Brent, which drops from $690. Olobendo, which was initially at $650, now dropped to $550. That is another thing that has dropped down in terms of where some of those disconnects are. And then when you look at Saxy, was initially at $1.50, now dropped to 50 cents. So when you look at, okay, well, this is for end of August into September. Well, for October. So when you start looking at the loading period in October, that's why it's like, okay, well, they're already saying that they're only going to do about just over 1 million barrels a day, but they're putting that out there, and yet they're still cutting differentials. And again, that comes down to the pressure that we're seeing in West Africa. Vital cut its offer price for Mangi crude on the Platts window, as Senegal obviously continued to reduce. Vital lowered it loading at 515 less dated Brent versus the initial offer versus the offer of 420 below dated Brent. So again, you're seeing more of that softness coming through in general. A total of 3.46 million tons of August loading Urals were headed to Europe, down from 3.54. So again, that represented about 40% of total Ural exports this month. Asia will receive at least 2.66 million tons of August loading Urals, but that's below the 3.66 seen in July. So again, some of that normalization lower. The volume is expected to be revised higher as tankers with a combined 1.14 million tons have yet to show final destinations. So again, that's where, and again, this is a bit older because the tanker trackers is now showing a spike in China, and that's because some of that is being committed going over there. Angola is scheduled to export almost 1.01 million barrels per day in October, the lowest level for any month since July 2021. But they're doing that while cutting differentials, which is some of the things that we continue to highlight as the oddity in terms of the different structures. Genscape, crude oil storage in Europe still remains low. Some of that should shift as some of the Iraqi crude again flows over. So again, we should start to see this creep higher. But again, not a huge spike, but as the Rhine has gotten a little bit better, we should see some improvement there. So we talked about these numbers on the FSC show. Gasoline storage in Europe spiked. Same with naphtha, gas oil up 183. But again, when you start looking at fuel oil, So naphtha going up, petchem's coming down, naphtha's going to continue to go up, but gas oil's at a record, and fuel oil's is coming close to a record. So we need to address that. So here, when we look at gas oil, they've started to get those big imports starting to go up, but you can see why. Since 2007, this is the lowest it's ever been. So again, you're still seeing, even though there was a build and it was a nice build, it's still well below where they should be this time of year. While gasoline had a huge surge back well over, again, setting a new all-time record of gasoline inventories. They're going to have to start exporting that. The U.S. will be the beneficiary of it as more of this flows into the U.S. And again, it's just because storage is so high, even though rates of shipping rates still remain elevated, they're still going to have to move that product through. Fuel oil, you can see here, just kind of eking out. I'll cop out and say seasonally adjusted all-time high, but realistically, it's just right where it was in 2020. It's the highest level for 2022, which is why they're going to have to accelerate some of these exports and again into the Asian theater. Singapore, when you look at totals, as we said last week, had a nice spike. And as we said, for total stockpiles, we expected to hang out around this 15, 17-year average. But it's, again, so now we had a nice spike up. We'll have a little bit of a drawdown. But total will stay right at that, let's call it purple fuchsia line right in the middle. So then when we look here, Singapore light distillate still all-time right at a seasonally adjusted high. Still not at the highs for 2022, but you can see still staying at those elevated levels. That is going to remain the case because you have the Middle East that dumped that gasoline into the market. And that's going to trap a lot of this light distillate there. All the while, middle distillate continues to remain in a very bullish position. And this is this was also part of some of that arbitrage into Europe, which is going to keep them at a record low place. Only time it was lower was 2013, and we don't see that changing. And then when we look at resid, again, back to the average, and we just see it hanging at that average side. North Sea, small increase in flows. Again, it's just going to be a matter of how quickly can it get pushed into the market. So we still see that floating storage remaining fairly low for the North Sea, as Europe continues to remain right around the average. And we don't see much adjustment there, just because even though the Rhine has gotten a bit better, you still have issues moving it through. You still have low run rates from a refining perspective. So it's just a matter of when does this floating storage go internal? And that's going to, again, keep that elevated and on the outside. So that's what we have for you on the international front. And hopefully this is helpful. If you have any questions, you can find us either in the comment section, Twitter. As always, we appreciate your viewership, and we try to give you the data. As much as we try to give you where we think the data means, we also try to show you our work and the data sets itself. So again, thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.